If you wander through an enclosed American shopping mall today, you see the physical evidence of an industry in structural decline. The standard financial profile for these legacy retailers is bleak. They carry shrinking single-digit margins, massive debt from private equity buyouts, and balance sheets nearing insolvency. Run a sector screener, and an anomaly appears, a green dot breaking away. That's the buckle. It defies the category: 16% margins, zero debt, and $324 million in cash. The valuation paradox? It trades at 11 times earnings, while peers trade at 19. This gap forces a question. Is Wall Street accurately pricing a dying mall brand for its inevitable heat death? Or are algorithms lazily slapping a sector penalty on a business that doesn't share its peers' financial DNA? The numbers suggest this is a deeply mispriced, cash-generating machine hiding in plain sight. The buckle started in 1948 as Garb's Men's Shop in Kearney, Nebraska. For nearly 8 decades, it has executed a slow, methodical growth strategy, deliberately avoiding flashy flagship stores in major metropolitan centers. Today, that unglamorous footprint pulls in nearly $1.3 billion in annual revenue across more than 400 physical stores. This comparison chart demonstrates the gap in operational efficiency. While a typical specialty apparel brand fights to clear a 5 to 8% net margin, the buckle consistently retains 16 cents on every dollar of revenue. Management pairs this elite profitability with an aggressively old-school communication policy. They refuse to issue forward guidance, ever. Modern retail executives frequently rely on custom metrics like adjusted EBITDA to filter out operational missteps and present an artificially inflated picture of their quarterly performance. On this Q1 earnings document, the headline earnings per share is 92 cents, a massive beat. But management didn't spin it. They flagged a $19.1 million one-time settlement. Subtract that block, and the true underlying EPS calculates down to 64 cents. The market reacted instantly. Algorithms read past the headline and triggered a 9% single-day sell-off. Refusing to massage the numbers guarantees short-term volatility, but for long-term investors, it provides a rare foundation of absolute financial honesty. To understand the margin, you have to look at the merchandise. The core driver of the buckle's revenue is premium denim. This is an intensely crowded space. Larger rivals like American Eagle attack the buckle's price points directly from below, backed by massive marketing budgets and celebrity endorsements from stars like Sydney Sweeney. The buckle defends its margins through a heavy reliance on private label goods, which now make up nearly 48% of its total inventory. When you own the proprietary brand, you own the manufacturing relationship. Controlling the supply chain allows the company to capture the full retail markup without splitting the profit with a third-party vendor. This line graph maps that pricing power. The average price point for women's denim climbed to $92, absorbed without a volume drop. But the dynamic flips for men's. As younger demographics shift to athleisure, men's denim volume actually dropped by 1.5%. This imbalance creates an immediate operational risk. Overall inventory growth recently hit 13.5%, outpacing sales growth of 6.1%. If that inventory doesn't move, it inevitably triggers markdowns. The heavier structural risk sits in the real estate. 78% of the company's fleet remains trapped inside enclosed malls, a format facing a permanent secular decline in foot traffic. Yet a major demographic shift is mitigating that decline. The fashion cycle is abandoning the skinny jean in favor of vintage, wide-leg silhouettes, forcing consumers to replace their entire lower wardrobe. To capitalize on this replacement cycle, management is executing a self-help strategy, aggressively relocating their most productive mall stores into outdoor power centers and lifestyle complexes. While the anchor mall dependency is a genuine threat, the 48% private label penetration and an exhaustive matrix of unique sizes function as a highly stubborn pseudo-moat to retain the core customer base. That operational execution feeds an exceptionally clean balance sheet. The buckle carries exactly zero long-term debt and holds a $324 million cash reserve. The company guards this capital with extreme discipline. In 78 years of operation, they have never acquired another business. They also refuse to play the buyback game. Rather than trying to time the market, a strategy that routinely destroys shareholder value, they simply sidestep it. This pie chart illustrates disciplined capital allocation. Corporate governance is anchored by Chairman Daniel Hirschfeld, who holds a 32% block. The executive compensation model is mechanical. A fixed percentage of net income feeds directly into a cash distribution valve for management. If the bottom line contracts, their pay contracts. If the company posts a net loss, the bonus pool drops mechanically to zero. This visceral alignment between insiders and common shareholders dictates exactly where the free cash flow ends up. This Sankey diagram tracks the flow of the $1.298 billion top line. The cash moves down through the business, entirely bypasses the empty nodes for acquisitions and share buybacks, and pools at the bottom into a massive $225 million special dividend fund. The company issues a variable, year-end special dividend, calibrated to distribute whatever cash the business didn't use for operations. Combined with the regular payout, this consistently generates an annual yield above 7%. Combining zero debt with total insider ownership exceeding 40% transforms a regional apparel retailer into a mechanical cash distribution engine. This brings us back to the central tension. If the cash flow is this consistent and the margins are this high, why does the stock remain stuck at an 11 times earnings multiple? The answer lies in how Wall Street processes information. Automated screeners group the buckle together with heavily leveraged distressed retail assets, applying a blanket discount to the entire category. This checklist outlines the phantom risks the market prices into the stock: crushing leverage, imminent covenant breaches, massive goodwill impairments, and hostile activist takeovers. But analyzing the buckle's isolated financial DNA eliminates these threats immediately. There is no debt to trigger a breach, no acquired goodwill to write down, and the 32% insider block makes an activist campaign mathematically impossible. Stripping away the false macro narrative leaves only the true operational risks an investor actually assumes: enclosed mall traffic declines, inventory creep, and stagnation in men's fashion. Those are real challenges. But they are manageable challenges when backed by a fortress balance sheet that holds roughly $6.30 per share in purely liquid assets. When a business carries zero debt, operational mistakes compress margins, but they do not threaten solvency. The downside is heavily cushioned. For value investors, this setup creates a highly asymmetric risk-reward profile. The buckle does not require an economic miracle, a technological breakthrough, or a rapid pivot in consumer behavior to justify its current price. It simply needs to keep selling jeans. While waiting for the market to realize this, the 7+% annual yield acts as a massive return floor. The cash quietly compounds for the patient investor. The bear case argues that Wall Street may stubbornly refuse to lift the dying mall penalty, trapping the stock in a low valuation purgatory indefinitely. But the underlying math of the special dividend renders the daily stock price secondary. Management drains the register and returns the excess capital directly to the owners, regardless of what the ticker reads. Wall Street's refusal to look past a lazy category label is the precise mechanism that allows a $1.3 billion debt-free denim machine to remain deeply, profitably mispriced.